Hey, I'm Jay. Welcome to smarthelping.com. What we're talking about today is a cost segregation study. Why do you want to do a cost segregation study? Well, it's simple. Would you rather have $50 spread out evenly over 13 periods, or would you rather have $350 now and then, something less, whatever the case is, the difference of those two over time, whatever that might end up to be? Well, the cost segregation study allows you to shift the cost of a building so your depreciation expense is not all over time and you get some of it up front, or not exactly up front, but you can accelerate the depreciation for different property classes by doing a cost segregation study. Why is that good? Well, it's still, in the long run, it's the same amount over time that you get to depreciate, but if you can get money now, you can invest that and that becomes worth more to you. So this template allows you to put in all the information for the cost segregation study, allows you to see the estimated net present value of that benefit over time. And remember, you can do these retroactively. If you buy a building in 2020, you do the cost segregation study in 2025. You can do that. You can do a cost segregation study one time in the life of the time you've owned the building. So you can do it retroactively though. So you do it in 2025. You get that tax benefit of the last 5 years up front right now. It could be four, five, six, $800,000. You'll get a less of a depreciation expense in the future, but money's worth more now than in the future, and negative money in the future is also worth less in the negative sense. This is why people do this. So you can see all the different benefits of like by year of doing the original straight line on the whole real property versus separating that out into different property types that have more favorable or faster depreciation schedules according to the IRS depreciation of real or per, we'll go through all the sections here. Um, so well, let's start on the template tab. So you can fill in your property information here: name, address, owner's name, the purchase details, what percentage of that's allocated to real property, which is going to be usually 100% because you're going to compare doing it fully here compared to doing the segregation style. Um, you got your basis for depreciation in column G all the way down. So the original allocation, here's your different property classes. Usually it's going to be all this because we're going to compare doing all here as opposed to putting some into these different types. Now I've tried to make this model robust so you can, if you have somebody come in and do a cost segregation study, it costs 5 to 15,000. They go through the whole property, they classify everything as different um, categories, and those different categories will have different recovery periods compared to a 39-year straight line for the whole thing. So that's all we're doing. We're shifting some of this cost basis into categories of property that have faster depreciation schedules. That's it. So this property or this template allows you to be really organized when you're doing this. You could do it by yourself as well. And remember, this is not financial advice. I'm not a tax advisor. This template's educational. I mean, it does have functional formulas in it, but use at your own risk. And I'm not liable for any way you may use this for any financial gain or loss. So use at your own risk and seek a professional tax advisor or attorney when doing these things. Okay, so original allocation, cost segregated approach, you list all the different individual items of properties and categorize them. We've got quantity, unit cost, salvage value, depreciation basis. Now, note salvage value is not used in some depreciation systems, it depends. The IRS doesn't use like for double declining balance or 150%. Um, so that could be a little bit of a difference between what you might do up here with a straight line. But other than that, we're just taking this whole 5.1 million and we're putting the depreciation basis into different categories of property. So we got personal property, we've got land improvements, we've got qualified improvements, real property. So this one, section 4, is important. This is where you're always going to put whatever ends up not being categorized into anything else. So core building. So it's essentially what we're shifting is it'll have a longer depreciation life, but we're shifting. So instead of putting 5.1 million into 39 years, here in this case, the remaining amount's 2.5 million, and everything else is going into these other categories. We've got qualified improvement property, other property class, just extra sections to try to fit anything that possibly could happen in your scenario. Again, the most important thing is you want the depreciation basis for each row slot to be accurate in column G, and then the model will look up the identifier column A and apply the different depreciation percentages per year accordingly. So you fill this out. Once that's done, you go to the depreciation rate CSS tab. Here you can define the depreciation percentage taken with all these different modified depreciation schedules. I shouldn't say modified, but to their proper depreciation schedule for that property category. I did all, you've got 129 slots here that match these 129 going down all the way to here, 129. So there's a column for every single slot, so you can account for any kind of different depreciation recovery period method used. Now these percentages, if you wanted to find it out, what they actually should be, I just put in hard-coded data here. You can look at the IRS publication 946. About 3/4 of the way down, you'll see something called publication 946 additional material, and that's going to give you information on the different tables to use, and it will tell you what percentage you should do based on if the property was placed in service in the first, second, third, or fourth quarter. That'll be the convention, mid-year or there's all kinds of different ways that will define the exact percentage of depreciation you should take in year one, and then over the life of the asset based on that schedule. So there's too many schedules to automate. It's a lot. So there's no to me the template's more useful by allowing you to input data here manually. The template will come with all this zeroed out, so you could fill in your own information to figure out what actual depreciation expense you can take. And then what the model will do is compare that to the original 39-year life, useful life version, and you can see the different tax benefits and net present value of that, and everything will go through that. You also put in the depreciation expense for the original property, whatever that might be. You can put in the percentage per year manually, and that's going to be how you're depreciating this initial amount up top. And remember, the amounts are the same. What's different is the cost segregation allows you to shift or accelerate the depreciation to get the cash now, the tax benefit now, and then you can take that and offset it with gains, and it should give you, and you can invest that, and that's why money is worth more today than it is in 5 or 10 or 15 or 20 years. So that's why people do this. Okay, so once we have that, you can see a summary. So this shows you the original allocation. This shows you the allocation after doing the cost segregation study based on inputting all this different data in here. And again, this data will be zeroed out as well when you get it, so you can put in your own information. The summary will also allow you to input the tax rate, the discount rate, the acquisition year of the property versus the actual tax year that you're performing the cost segregation study. And like I said, it could be the same year. It could be, 4 years in the future, 2024. That will change the benefit you're getting because you can recover that cash that you got from additional deductions that you didn't take. So you've also got the 10-year net present value, the full net present value of the whole life of the asset, the amount that was accelerated, year one cash flow. In this case, when we do the segregation study in 2024, we're getting 748,000 in year one is the tax year in this case. Now, if you want to see, so when you put in these percentages for the cost segregation property categories, the amount will populate here. This is what we're basing all of our calculations on. And I have categories up here in row 1 and 2, so you can kind of see what it is. And it is here as well. You can see the category, so it's easier to fill in. And then the yearly comparison, so C to H is summing up everything you see here on the actual depreciation of the cost segregation study, which is again based on these percentages. So that populates here in aggregate, and we see the total in column I. There's your actual depreciation expense if you were to have done the cost segregation study from the moment the building was placed in service or purchased. Then you've got column J as the original depreciation. So this is just your regular straight line. And then which you can configure right here on the original percentage, and you can adjust these percentages as needed. And then you got the column K's, your additional deductions. So if you did the CSS, here's what you could have depreciated that you didn't. It's going to be more in the first few years, depending on how your schedules are for these different property classifications. And then in the long run, you'll see negatives down here. But the idea is that the value of money today is worth more than in the future, and especially negative. Negative 65,000 in year 2058 is not worth negative 65,000 to you today. The impact of that to you on your money now is a lot less. Just like a positive amount in the future is worth a lot less today. So you're shifting all these positive amounts to the first few years. Here's your additional cash flow based on the taxes. And you can see we've done some timing assumptions where you've got, column B is showing you the age of the property since you purchased it. Column Q is showing you the year that the discount rate is applied. So year 0 is technically no discount because you're doing the study in that year, in this case 2024. This is where we get our additional benefit. You've also got a 481A adjustment, 1.6 million. That's the additional deductions that you didn't take. So 1, 2, 3. So up to 2023 because you're doing the segregation study in 2024. So it's giving you all that retroactively as additional deductions to take in the current year. The benefit is going to be the tax rate applied to that amount. You're also getting the current year deduction. So that's where we're coming up with, that amount. And then the resulting effect based on the taxes is where we get the 748. So this is year 1 relative to the cost aggregation study, and then we go forward from there. Now, obviously, the net present value is going to go down because we're getting negatives after this first big chunk was taken, because now we don't have as much depreciation to take in the future, which is completely fine. The whole point of this is, hey, I can, instead of getting the same amount of money over 10 years, I can get the same amount of money, but more of it now. And then I can invest it, and that's why you invest in more property or whatever, what have you. And then discount rate, we did some charts. I did some charts here. You can see the NPV savings over time, additional deductions. This is your variance of the CSS versus the straight line. You can see the straight line depreciation here by the straight line versus the accelerated. Here's the accelerated, same amount over time, but again, this acceleration gives you access to more of the money sooner with no negative benefit. You just get more of it sooner, and you can do whatever you want with it. Original yearly depreciation versus cost segregation study yearly depreciation. So here's your cost segregation study amount, the blue here, and then straight line is obviously the straight line. So you get more up front, a little bit less in the future. Now, what else? I think that covers pretty much everything for the template. I'm really happy with how this turned out. I think this actually has real value if somebody's doing a cost segregation study, or if an owner just kind of wants to dabble in this and see what the benefit would be. You can do it. And again, you can categorize these into higher level categories as long as the category has the same recovery period. It doesn't matter as far as the actual amount, but I wanted this template to be useful if you had a lot of detail you wanted to include. But like if all these had 5-year MACRs, then you could technically put them all in one row because that's all going to go into this depreciation basis, and you could define that percentage depreciation per year in this schedule manually. And then the different categories like personal property, land improvement, qualified improvement, that's to give you just a summary, although you want to make sure number 4 is always real property. So whatever of the original purchases staying categorized as, core building with the straight line you want to keep in row 4, because that's always going to come through right here, and that's going to be compared for your total accelerated amount. Um, but the model is very robust. So again, you can define the depreciation expense percentage per year for everyone individually. It's going to take that summary here, compare that total to the original, and get the benefits. And you could change this. Like if you did the if it was tax year 2020 when you did the segregation study, everything happens right now. That's fine. All this adjusts accordingly. You see all the numbers reflected and updated dynamically. So the benefit starts right up here because we're doing a study in the same year as acquisition, and here's the resulting NPV. Again, I'll clear out all these percentages so when you get the template, you can fill in your own data. And yeah, I mean, that's all I got for you. The template, if you want to purchase this, it's a one-time fee. The link is in the description box below. Also, it's going to be included in my accountant's template bundle. I've got a lot of different templates for accountants. This will be included in that, and I'm not going to increase the price of that template bundle purchase either. Alrighty, well, that's all I got for you. I think this is a really useful spreadsheet. Cost segregation. Like the video, subscribe, and oh, remember, if you do want to check out more, you can go to smarthelping.com, and I've got all kinds of templates here. This is the accountant's bundle. I'll probably put this under the calculators category when I upload it to the site today. And if you want to buy all these templates, it's $249. You get everything, or you can buy them, individually as well on the product page. And you could buy everything I've ever built if you go to the Super Smart Bundle at the top of the Financial Models tab. And for $9.99, you get access to all the spreadsheets on the entire site. I think it's a very fair price. The knowledge in years of expertise in building all this stuff is super valuable. I've done a lot of financial modeling, not just accounting tools, but all kinds of different financial models, forecasting templates for all kinds of different businesses. You can see here I've done a lot of stuff in the SaaS space, a lot of real estate underwriting tools with refis, IRR hurdle, different cash flow waterfalls, all kinds of different industries here. So I've got a lot of templates. Very valuable, very, very valuable logic, and hopefully a lot of people can benefit from all this stuff. I do have bulk discounts available if you buy individual templates automatically in a cart. You'll get discounts based on this volume of templates purchased, and this does apply to bundles as well. So if you buy a couple different bundles, the discounts will apply just the same. Alrighty, take it easy, and don't forget to check out the site.